Alright, let's start with loans receivable. So this is still part of our receivable, but we are going to focus more on the loans receivable. This is an asset account used by banks or other financial institutions on loans receivable. The banks and the financial institution, they are called the lenders. And the company or the person that wants to borrow money from the lenders or the bank or other lending companies, they are called the borrowers. On the books of the lenders, so they record this account called loans receivable. On the books of the borrowers, they record the accounts loans payable. The lender earns an interest income while the borrower incurs an interest expense. This loans receivables started when a borrower applies for a loan to the bank or to the lender. It starts with an application. So when the lender receives the applications of the borrower, so the lender will process these documents. Then after processing these documents, it will be the granting of the loan. So under processing these documents, some of these are These are some of the steps in originating this loan. Preparing and processing of documents, evaluating and recording the collaterals, evaluating the borrower's financial condition, that's very important, and closing the transactions. Then after the processing of the documents, then the granting of the loan. In doing this process, the lender incurs a cost, and this cost is called transaction cost. This transaction cost is specifically called origination cost. On the part of the lender or the bank is called origination cost. On the part of the borrower, any origination cost that is charged to the borrower will be called origination fees. So now let's get into the accounting of the loans receivable. So on loans receivable, we have our initial measurement and our subsequent measurement. On initial measurement, this is the initial carrying amount of the loans receivable on transaction date. And our subsequent measurements. So subsequent measurements, this is the carrying amount of the loans receivable on financial statement date. Our initial measurement or the initial carrying amount of the loans receivable on transaction date will be calculated. So we will start with the principal amount or the fair value. Then we plus or we add our origination cost. And then we will minus the origination fee that we charge to the borrower minus origination fees. Then we will come out, this amount is what we called initial carrying amount on the transaction date. So we start with the fair value plus the origination cost minus the origination that we receive from the borrower. The fair value is actually the principal amount of the loans receivable. The principal amount is the amount granted to the borrower. Then the origination cost. Origination cost has two kinds. So there are two kinds of transaction costs, or also we call it as origination costs. We have the direct origination cost and the indirect origination cost. The direct origination cost is included in our originations to get our initial carrying amount. So this origination cost, this is your direct origination costs. Alright, so direct origination cost is included in our computations for the initial carrying amount, while the indirect origination cost is outright expense. And once we expense this, our entry will be debit to administrative expense and credit to cash. And the origination fees received from the borrower, this is the amount charged to the borrower. And the subsequent measurement of our loans receivable, which is the carrying amount on the financial statement date, will be measured at amortized cost. So how do we get our amortized cost? This is how we compute or calculate our amortized cost. So we are going to start with the principal amount. Then we will less or plus on amortizations. So what is this amortizations? I will discuss this amortizations in a little bit here. So we have our amortizations. So let's say that's a minus. All right. Then we will minus any impairment loss, which we are going to discuss this in a separate video because it's a longer video lectures. Then the amount will be our amortized cost. All right, so this is our loans receivable. All right, then let's get into the accounting of the loans receivable. We will start with the initial carrying amount of this loans receivable on transaction date. All right, so we will start with principal amount. Then we will add the origination cost. Then we will minus our origination fees received from the borrower. Let's put some amount here so we can do our journal entries. Let's say, for example, we have a principal amount of 1 million. So the bank granted 1 million amount of loan to the borrower. And then let's say, for example, our origination cost is 10,000. The origination fees received from the borrower or the amount charged to the borrower is 25,000. We get our initial carrying amount as 985,000. So we come up with 985,000 as the initial carrying amount of our loans receivable. Now let's see our journal entries on these transactions. So on the principal amount that we grant to the borrower, our entry will be debit to loans receivable of 1 million and we credit to cash of 1 million. Now the origination costs incurred by the bank, our entry will be debit to unearned interest income of 10,000 and credit to cash of 10,000. So this is the origination cost incurred by the bank. Then the origination fee of this 25,000, our entry will be debit to cash of 25,000 and credit to unearned interest income. When you see your unearned interest income T account, so we have a debit of 10,000 and we have a credit of 25,000. So the ending on this unearned interest income will have a balance of credit sides of 15,000. This is your ending balance of your unearned interest income. Let me give you another example here. So we have principal. All right, let's say we have the principal amount of 1 million and this time our origination cost is 40,000 and the bank charged the borrower less than the origination cost. Let's say, for example, we have origination fees received from the borrower as 10,000. So our initial carrying amount of the loans receivable on this example is 1,030,000. So let's do the journal entry on this example. So on the principal amount that we gave or we granted to the borrower, our entry will be debit to loans receivable of 1 million and credit to cash of 1 million. So the origination cost is greater than the origination fees charged to the borrower. So we will charge this into a different account. Our entry will be debit to direct origination cost of 40,000 and credit to cash of 40,000. So the origination fees received from the borrower, our entry will be debit to cash of 10,000 and credit to direct origination costs. So when you see your T account for the direct origination costs, so we have 40,000 on the debit side and we have 10,000 on the credit side. So our ending balance for this direct origination cost will be 30,000 on the debit side. So if the principal amount is greater than the initial carrying amount of the loans receivable, as if we have earned 15,000, which is charged to the unearned interest income. On the other hand, if the principal amount is less than the initial carrying amount, as if we lost the 30,000. So the 30,000 will be charged to the account called direct origination costs, and that's going to be the debit side. All right. So how do we present this direct origination cost or our unearned interest income in our financial statement? And what do we do with these two accounts? We will amortize these two accounts over the life of the loans receivable. So before we get into the amortizations of the two accounts, the direct origination cost and the unearned interest income, let me give you more an overview of these two accounts. So this account arises when the initial carrying amount of the loans receivable is different from the principal amount. Let's get that example a while ago where our principal amount is 1 million. And one of our example, the initial carrying amount is 1,030,000. That means it's greater than our principal amount. So let's say our initial carrying amount is 1,030,000. So the difference of 30,000 is what we call the premium. So the premium, as if the bank lost money from granting these loans to borrower. So premium is as if we had lost. All right, and this premium of 30,000 will be charged into an account called direct origination costs. And our financial presentations of this direct origination cost will be added to the loans receivable to get the carrying amount. So we have our financial statement presentation. So we have our loans receivable of 1 million and we add the direct origination cost to get the carrying amount of the loans receivable. So the carrying amount on this example is 1,030,000. So the 30,000 of the direct origination costs will be amortized over the life of the loans receivable. All right, so let's get another example where the initial carrying amount of this loans receivable is less than the principal amount. Let's say, for example, on our example a while ago, we have an initial carrying amount of 985. So the difference of 15,000 here, so the difference of 15,000, this is what you call discount. So the 15,000 discount as if the bank earns or gains some money on these transactions of granting the. So the discount is a gain. But this gain of 15,000 will not be recognized on the date of the transaction or the granting of the loan. Okay, this 15,000 other gains will be amortized over the life of the loans receivable. And this discount will be charged into an account called unearned interest income. All right, and on the financial statement presentations of this scenario where we have unearned interest income or a discount will be, so our loans receivable will still be 1 million. Then we will less our unearned interest income. So now our carrying amount of our second examples will be 985,000. Now let's see, how do we journalize our amortization? So what is our journal entry when we amortize this direct origination cost or this unearned interest income? So our entry, all right, so when we amortize this direct origination costs, we will debit interest income and we credit the direct origination costs. All right, that's our entry when we amortize the direct origination cost. Then we will talk about the calculations of the amount of the amortizations in a little bit here. So on the unearned interest income, our journal entry of the amortizations of this amount will be debit to unearned interest income, and we credit the interest income. So this is our entry when we amortize our unearned interest income of 15,000. We debit unearned interest income and our credit our interest income. So you see, on the unearned interest income, the amortizations of this will increase our interest income. So on this discount, it increases the interest income, while the premium decreases the interest income. And now let's talk about the computations or the calculations of the amortizations of this premium and this discount. There are three methods of amortizations. We have our straight line method, our outstanding balance method, and our effective interest method. And usually we use effective interest methods on a loans receivable amortization. But we will discuss about straight line methods and effective interest methods in a separate video. Now, on this example, we have our principal amount of 1 million, and this principal amount earns a 10% nominal rate. A nominal rate, this is the rate stated on the loan agreement. This is also what you call stated interest rate and also coupon interest rate. Those are the same. Every year, the borrower will pay the bank 10% of 1 million, and that is 100,000. Let me draw my timeline here. So we'll start with our transaction date up to our maturity date. All right, let's say we have our first year here, our second year, and our third year. All right, so every year the borrower will pay the bank 100,000, which is computed as 1 million times the 10% annual nominal annual interest rate. So on the first year, the borrower will pay the bank 100,000. On the second year, the borrower will also pay 100,000, as well as on the third year, the borrower will pay 100,000. Right? And that is computed as, okay, let's see, we'll put it here, 1 million times 10%. So on the first year, 100,000, second year is 100,000, and third year, 100,000. Our entry when we receive this 100,000 from the borrower will be debit to cash of 100,000 and credit to interest income. Now, if our initial carrying amount is the same as our principal amount, then we don't have to amortize any of the difference between the principal and the initial carrying amount. So we won't have an amortizations. So if we don't have an amortizations, then our interest income is the same as the interest income that we receive from the borrower. But since we have a difference between the initial carrying amount and the principal, then we have to amortize this difference over the life of the loans receivable. So let's say we will amortize our 30,000 premium. Let's see, let me put my timeline here. This is our transaction date or the granting of the loan. So on the transaction date, our initial carrying amount or initial carrying amount of our loans receivable will be 1,030,000. And on the maturity date, our loans receivable should be our principal. So on the maturity date, our loans receivable should be the same amount of our principal. We have our first year, our second year, and our third year. All right, we will amortize the 30,000 and we will use a straight line method. Straight line method is a straightforward computations or calculations of our amortizations. We take our 30,000, we divide this over the life of the loans receivable. So the computations of our amortizations of 30,000 using a straight line method is 30,000 divided by 3 years. So on the first year, we will have an amortizations of 10,000. And this 10,000 will be minus the carrying amount of your loans receivable. All right? And then minus on the second year of another 10,000 and minus another 10,000 on the third year. Then we will have a 1 million on the maturity date as the principal. All right, and our entry on this amortizations every year will be debit to interest income of 10,000 and credit to direct origination costs. So on the first year, after you amortize the 10,000, your direct origination cost will be 20,000. So on the first year of this loans receivable, our interest income will be 90,000 because we receive an interest of 100,000, but we amortize the 30,000 premium. We debit interest income, so we deduct a 10,000 of the interest income we earned or we receive. So all in all, the effect of this premium of 30,000 is decreased on our interest income. So the effect is decrease on income. Let's amortize our 15,000 discount. Let me draw my line here or my timeline. This is your maturity date and this is your transaction date. So the discount of 15,000, remember this discount as if we gained amount of 15,000 on these transactions, but this 15,000 will not be recognized on the transaction date, but we will amortize this gain over the life of the loans receivable. So on the transaction date, our carrying amount of our loans receivable will be 985,000. All right, so on the maturity date, our carrying amount should be the principal amount of the loans receivable. Using straight line methods of amortizations, our 15,000 will be divided into the 3 years life of the loans receivable. So our computations will be 15,000 divided by 3 years, and we have 5,000. All right, so on the first year we will amortize 5,000, but this will be an addition to the initial carrying amount of the loans receivable. And then on the second year we will have 5,000 amortization, and on the third year will be 5,000 to equal the 1 million principal amount on the maturity date. All right, and our entry on this 5,000 amortizations of the discount will be debit to unearned interest income of 5,000 and credit to interest income. The amortizations of your discount will be additions to your interest income. So the discount increases the income or the interest income of the bank. So the effect of this is increase in interest income. The concept of amortization is to bring the carrying amount or the initial carrying amount to the amount of principal or the principal amount on the maturity date. This is the amortizations using our straight line method. The only difference between the straight line and the effective interest method is the amount of the amortizations. So on the straight line, it's a straightforward. We will divide the amount into the number of years of or life of the loans receivable. So let's try a multiple choice questions with regards to loans receivable. So I will flash the problems on your screen. Pause your video, then solve this problem. When you have your solutions and your answer in front of you, then play this video again. Then we will solve these multiple choice questions together. Ready? The number one requirement on this problem is what is the initial carrying amount of this loans receivable on January 1st, year one, on the transaction date. The initial carrying amount of the loans receivable, we are going to start with the principal amount, okay? On this problem, the principal amount is 5 million. So we are going to start with the 5 million. So we have 5 million, and on the principal, we are going to add the origination costs. So on this problem, there's two origination costs, the direct origination cost and the indirect origination cost. The indirect origination cost is an outright expense. The direct origination cost is included in determining the initial carrying amount of your loans receivable. So we will add the direct origination cost of 50,000 minus the origination fees charged to the borrower. On this problem, our origination fees charged to the borrower is 100,000. So we are going to minus this 100,000. Then we will come out with our initial carrying amount of our loans receivable requirement number one, which is 4,950,000. And our answer will be letter B. Number two requirements on this problem is what is the interest income for year want. So for the interest income, we are going to start with the interest income received by the bank. And on this problem, the interest income received is calculated from the principal of 5 million multiplied by the 8%, which is the nominal rate. So this is equal to 400,000. Then we will add our amortizations. Our amortizations of the discount. Why discount? Because the principal amount is 5 million and the initial carrying amount of this loans receivable is 4,950,000, which is less than the principal. So there's a difference of 50,000. And this 50,000 discount is amortized over the life of the loans receivable. In this case, the 50,000 divided by the life of the loans receivable. On this problem, it's 10 years using straight line method. Okay, so 50,000 divided by 10 years. Every year, we will amortize this 50,000 for 10 years, and we will add 5,000. So the interest income for the year is 405,000. Your answer is letter A. The requirement on the number 3 is what is the carrying amount of this loans receivable on December 31st, year 1. So from the initial carrying amount of 4,950,000, we will add our amortizations of 5,000. Therefore, carrying amount of this loans receivable on December 31st, year 1 will be 4,955,000. And our answer is letter C. So this is our answer on this multiple choice questions.